You're staring at $98.54 on your screen. You're watching green candles push toward $99. You think you're watching history. You think this is the moment. You're wrong. What you're seeing isn't the story. It's the echo of a story that already happened somewhere else. While you were celebrating a number, the actual market moved without you. Shanghai Futures Exchange just posted $113 per ounce. Not $100. Not $105. $113. That's where silver is trading right now in the physical market. The gap between New York and Shanghai isn't closing. It's detonating. We're looking at a $14 spread on a sub-$100 asset. That's not market inefficiency. That's a fracture. The pricing mechanism in the West just broke in front of you. Here's what a $14 gap does. If you buy silver in New York at $99 and move it to Shanghai, you capture $14 per ounce by doing nothing but relocating metal. 14% return for moving a box. That's not a trade. That's a raid. The United States is now the global discount bin for silver. We are the cheapest seller on earth. And because of that, we're being stripped. Every ounce sitting in a New York vault is a target. Arbitrage players are locking physical, pulling delivery, and shipping it east to bank that $14. This is why the price just teleported from $94 to $99 in one session. You think that was retail hype? You think that was Reddit? No. That was New York trying to stop the bleeding. The price is rising to choke off the drain. It's trying to find a level high enough that the metal stops leaving. But every time New York bids $99, Shanghai answers with $113. China isn't negotiating. They're saying, name your price. We'll beat it. This is the part where the ceiling disappears. If you thought $100 was the top, you were reading the wrong chart. $100 is the starting line. With Shanghai at $113, the $99 New York price is a 12% discount to the real clearing price. That gap is what's driving the panic bid you're watching right now. The market just realized that double-digit silver is a fiction that only exists in one time zone. But this isn't about the number on your screen. This is about flow. A $14 spread guarantees directional flow. One way. Out of the West. Into the East. We are draining our strategic metal reserves because our financial system refuses to price them at reality. We are subsidizing the industrial future of our geopolitical rivals by selling them silver at a discount they didn't even ask for. The system is calling this a runaway market. That's exactly right. The price isn't anchored to the dollar anymore. It's anchored to physical supply and demand in the places that actually make things. And in those places, silver is $113. So what happens next? We're sitting at $98.50. We're inches from $99. The psychological weight of $100 is real, but the arbitrage pull of $113 is stronger. If we crack $100, the next magnet is $113. There's no resistance in between because there's nothing in between. The banks might try to defend $100. They'll try to build a wall. But how do you defend $100 when the rest of the world is paying $113? You can't. If you sell at $100, you're selling at a loss relative to the global price. You're paying people to take your metal. This is why the short squeeze is entering its final stage. The shorts aren't just fighting long positions. They're fighting the global shipping network. They're fighting physics. The rally to $99 wasn't a bubble. It was a correction. We are correcting upward to match what the metal is actually worth. The vault data confirms it. 4.2 million ounces of silver were yanked out of COMEX depositories in a single day. That's not a number. That's an evacuation. That's 130 metric tons of silver. That's armored convoys. That's cargo planes at capacity. That's a bank run, except the bank is made of metal. Let's see who got hit. 1.2 million ounces out of CNT. 600,000 out of Asahi, 1.6 million out of Brinks, and the nightmare, 1.28 million ounces out of JPMorgan. JPMorgan was the fortress. For a decade, the assumption was that if the market got tight, JPM would release metal to calm things down. The fortress just got breached. When over 1 million ounces walk out of the JPM vault in 24 hours, it's telling you the smart money doesn't trust the system to hold their assets anymore. They're taking possession. They're moving metal from financial storage to untouchable storage. Why? Shanghai. If you own silver in a JPM vault and you see $113 in China, you have a choice. Sell on COMEX for $99 and feel clever, or withdraw it, ship it east, and collect $113. That's $14 profit per ounce just for moving a pallet. The vaults are bleeding because the arbitrage gap is extracting inventory faster than the system can replace it. But the real danger isn't total withdrawals. It's registered inventory. COMEX silver comes in two categories: eligible, which just sits there, and registered, which is available for delivery against futures contracts. Registered is the float. It's the only metal that backs the pricing system. Registered inventory just collapsed by 1.7 million ounces. It's down to 114 million ounces total. At $100 per ounce, the entire registered stockpile of the COMEX, the inventory backing the entire global silver futures market, is worth $11 billion. $11 billion. That's a rounding error. That's less than the market cap of a struggling tech company. Elon Musk could buy the entire COMEX registered float with pocket cash. And that float is losing 4 million ounces a day. If this rate holds, the registered stock will be gone in weeks. When that happens, price discovery doesn't go to $113. It goes to no offer. It goes vertical. The 4.2 million ounce drawdown is the market positioning for default. Insiders are pulling their metal now while the doors are still open. They know that once registered inventory drops below critical mass, the exchange will rewrite the rules. They'll force cash settlement. They'll lock the exits. The whales are leaving before the lights go out. The registered collapse creates a leverage crisis. Every COMEX futures contract represents 5,000 ounces. The open interest represents hundreds of millions of ounces. The ratio of paper claims to registered physical metal is exploding. There are hundreds of paper claims for every ounce of real metal in the vault. As long as nobody asks for delivery, the game continues. But the 4 million ounce withdrawal proves people are asking. Paper holders are converting to physical holders, and there are not enough chairs. This is why the price is at $99. The market is searching for a number high enough to make someone sell. But who's selling? JPM withdrew 1.2 million. CNT withdrew 1.2 million. Asahi withdrew 600,000. The vault operators are net takers. If the people running the vaults are hoarding, what does that tell you about the future? It tells you $99 is cheap. It tells you $113 is cheap. Silver is being remonetized. It's shifting from a traded financial asset to a hoarded strategic asset. The Wednesday night vault raid is the proof that smart money saw the Shanghai price enacted. They're arbitraging the system to death. Now watch the U.S. price chase. We're at $98.54, grinding toward $99. This is the catch-up. For years, COMEX was the engine. New York set the price, and the world followed. Today, the polarity flipped. China is the engine. The United States is being dragged. The reason silver is hitting $99 in New York isn't American demand. It's arbitrage forcing the price higher. Think of two water tanks connected by a pipe. Shanghai is filled to $113. New York was sitting at $94. When you open the valve, water rushes from high to low until they equalize. The only way to stop the drain is for the New York level to rise. We are watching it rise in real time. But $99 is dangerous. It sits right below the psychological barrier of $100. Normally, You'd see resistance here. Traders take profits. They think it can't go higher. But ask yourself, who's selling at $99 when they can get $113 in China? The sell wall evaporated. There are no sellers. The only sellers left are the trapped shorts. The banks fighting for survival. And they're out of ammunition. This is where weekend risk enters. Normally, traders go flat for the weekend. They don't want exposure while markets are closed. But in a breakout, the risk inverts. The danger isn't holding the position. The danger is not holding it. You're a hedge fund manager. You see silver at $99. You see Shanghai at $113. You see vaults draining. And you know that over the weekend, anything can happen. China could ban exports. The Mint could announce closure. The Middle East could deploy another billion. If you're short silver, you're betting nothing happens for 48 hours. Nobody wants that bet. So Friday becomes a short covering stampede. Traders who sold silver they don't own will panic buy to close before the weekend. They don't want to wake up Sunday night and see silver gapping to $110 in Asia. Fear of the gap is a powerful engine. It pushes price up even without new catalysts. The fear of what might happen is enough. And look at $99 itself. It's a signal. The market is telling you the double-digit era is ending. When silver moves from $99 to $100, it changes identity. At $99, it's a volatile commodity, something you trade. At $100, it's a store of value. It joins the asset class that pension funds and family offices respect. The psychology shifts. People stop seeing it as expensive and start seeing it as valuable. Retail is rushing in. They're looking at $99 and they're not scared. They're excited. They see momentum. They want in. But here's the trap. They're buying paper. They're buying the $99 contract. They don't realize that contract is a claim on a vault losing 4 million ounces a day. They're buying exposure to a market that's collapsing under physical demand. The catch-up isn't just price. It's reality smashing into fantasy. The U.S. market has been living in a world where silver is cheap and abundant. That world is ending. As price pushes through $99, it destroys the bear case. Bear said silver was in surplus. Bear said industrial demand would collapse in recession. Bear said high rates would crush precious metals. $99 proves them wrong on every count. It proves the deficit is real. It proves industrial demand is inelastic. And it proves rates don't matter when the currency itself is being questioned. So as we head into Friday, watch the spread. U.S. price, $99. Shanghai price, $113. Gap, $14. As long as that gap exists, the trend is up. The arbitrage vacuum will not stop pulling until prices converge. And because Shanghai is the physical market, it's the anchor. It's not moving down to meet New York. New York is dragging itself across the ocean floor to meet Shanghai. This is why $100 isn't a ceiling. It's a magnet. The banks can fight for a few hours. They can try to paint the tape. But they can't fight the hydrodynamics of global capital. Money is flowing to metal. And right now, metal is priced at $113. Now we enter the most dangerous 48 hours. The weekend. It's Friday morning. Silver is hovering under $99. The market is tense. The air is electric. In a runaway market, the Friday close is everything. It tells you who's in control. If the banks smash price back to $95, they survive another week. They signal resistance is alive. They create doubt. But if bulls hold $99 or break $100, the game ends. A strong weekly close forces risk models to recalibrate for weekend gap scenarios. Let's talk weekend exposure. You're a commercial bank. You're short millions of ounces. You're underwater. You're bleeding. And Shanghai is trading at $113. You know the physical market doesn't sleep on weekends. While COMEX is dark, deals are closing. Mines are being acquired. Refineries are being booked. Supply is moving. If you hold a massive short into the weekend, you're gambling. You're betting no news breaks for 48 hours. You're betting China doesn't ban exports. You're betting the Mint doesn't announce permanent shutdown. That's a terrifying bet. In volatile markets, headlines break when markets are closed. If news hits Saturday, price doesn't tick up. It gaps. It opens Sunday night $10 higher than Friday's close. If you're short and the market gaps $10, you can't exit. You're trapped. Your stop loss is meaningless. You open the week insolvent. This fear drives Friday's short covering. We expect banks to buy back positions today, not because they're bullish, because they're too scared to stay short. They're flattening books. They're cutting exposure. And when a short covers, it's a buy order. It pushes price higher. Self-fulfilling prophecy. Fear of higher prices creates higher prices. Look at the technical setup. In the options market, $100 is stacked with call strikes. Thousands of contracts sit at that level. If price breaks $100, market makers are forced to hedge. They have to buy futures to offset risk. That's a gamma squeeze. It's a magnet. The hedging accelerates, pulling price closer. It creates a gravitational field. Banks are fighting gravity. They're trying to hold price at $99 to prevent gamma detonation. They're selling everything to keep it in double digits. But they're fighting the Shanghai spread. Every minute New York stays at $99, arbitrage players are backing up trucks. They're buying cheap New York to flip in China. The banks are being crushed from both sides. Gamma is pulling them up. Arbitrage is pulling them up. The only force pushing down is their own desperation. This is why Friday's close is the verdict. If we close strong, Monday opens violent. We're looking at gap and go. The market opens significantly higher and never looks back. It leaves a gap on the chart that doesn't fill for years. It's the signal the asset has repriced permanently. For retail, this weekend is a test. You'll see volatility today. Maybe a smash, maybe a rip. But the macro doesn't care. The vault drain, the 4.2 million ounce exodus, doesn't reverse on Monday. That metal is gone. It's not coming back. The shortage is structural. Price action is just the market discovering how severe it is. If we see a smash today, don't panic. View it as clearance. But if we see breakout, understand we're crossing the Rubicon. Once we're trading triple digits, global psychology shifts. Unit bias kicks in. Media frenzy begins. We're standing at the edge of a new era. The triple-digit silver era. Banks know it. Miners know it. The Chinese know it. The only people who don't know are the general public. They're about to find out when they turn on the news this weekend. We've reached the conclusion. If you've stayed through this, you understand the scale. The Shanghai breakout. The vault hemorrhage. The catch-up dragging U.S. price to $100. The evidence is forensic. We're not watching a trading anomaly. We're watching the end of the double-digit era. For 50 years, silver lived in two digits. It was $10. It was $20. It hit $50. But it never held three digits. Today, that ends. The move to $99 is the opening act. The main event begins when we cross $100. And when we cross, the rules flip. In normal markets, rising price kills demand. If hamburgers cost $100, people stop buying hamburgers. But silver isn't a hamburger. It's a Veblen good. Demand increases as price rises. Why? Because price is a signal of value and status. Think Rolex. Think Ferrari. Think Bitcoin. People don't buy them because they're cheap. They buy them because they're expensive. Rising price confirms desirability. When silver hits $100, it stops being a cheap industrial metal. it becomes a precious monetary asset. The high price is the marketing campaign. It screams to the world, this is valuable. This is real money. Once $100 breaks, momentum accelerates into new price discovery. What? Because fear of missing out detonates at triple digits. Retail sees headlines and thinks, I missed it. I need to get in before it hits $200. Buying panic. And this panic is hitting a market with zero supply. The mint is closed. Dealers are rationed. Vaults are empty. Vertical demand meets zero supply. That's a melt-up. So where does it stop? What's the ceiling? If $100 is the floor, what's the limit? Look at gold. Gold is approaching $5,000. Historically, the natural gold to silver ratio is 1:5 to 1. If you apply that to current gold price, the math is brutal. $4,950 divided by 15 equals $330. At a 1:5 to 1 ratio, silver's theoretical value is over $300. By that metric, $99 silver is massively undervalued. It's one of the most mispriced assets in the financial system. This is why banks are terrified. They know this math. They know if the market reverts to mean, their short positions vaporize. What's your move in the triple-digit era? First consideration, what are you selling for? You can take profits, sure, but profits in what? Fiat currency being printed by the trillion to bail out bond markets. Currency, the U.S. Mint can't even Usetto price its own coins. You're trading physical metal for inflating paper. That's a choice that requires clarity on what you value. Second consideration, asset rotation. Some hold until metal can be exchanged for income-producing assets. You wait for mania to overshoot. Some track silver to property ratios, watching for the moment metal can buy significant real estate. Current levels are early stages of a longer cycle. Third consideration, volatility management. Major price moves come with sharp pullbacks. Avoiding high leverage helps navigate turbulence. Volatility is noise. Trend is signal. The technical indicators show strong upward trajectory. The moving goalpost shifted to $113 in China. Soon it moves to $150. The U.S. market is the tail. The dog is running east. We're witnessing the greatest wealth transfer in history. From those who trust paper to those who trust metal. You're on the right side. Institutional shorts are facing extinction as vault inventories hit critical lows. The market is holding $99. Stay disciplined. Keep focus on macro. This is the moment you prepared for. We'll track this breakout every step. The era of cheap silver